Murali. Very good morning.
Good morning, sir.
Yes, good morning. So it's 9:30. Let us start. Warm welcome to the third day of the holiday batch or holiday sessions on BFMC. And simultaneously, some of your batches would have already covered part of B and maybe stepping into D. Okay, that's okay. So, where is that? Yeah. Today morning's question and yesterday's question on SDF. So based on these two, I thought I will spend some time to explain, because some of you yesterday also were not very clear and you wanted some more explanation. So that I will cover, and then we should hopefully today go into the complete module C except derivatives. That is my hope. Let us see. So just to give you the concept, I will still not recommend you to by heart the rates, especially rates between 30th June and say 1st December or something. I'm saying 1st December 2021. Which day you can ask? Every monetary policy, a 50 basis points hike has been there. But more than that, you should know how the two-way corridor operates. That is more important concept-wise. Even if one mark is there on the exact rate on an exact date, I would give you what's that pardon. Okay. So just I'm refreshing the corridor window which I had earlier put. I have slightly more altered it to suit the current position. Now this 3.35, that rate per se is not very sacrosanct. But what you should understand is RBI is a willing borrower of money, and therefore he does reverse repo. And banks which are surplus with money can go and park it with RBI at a fixed rate reverse repo of 3.35%, and in turn get government securities into the bank's investment book, which is eligible for SLR. Be very clear on those things. Simultaneously, earlier, a 40 basis points spread was there, or difference was there, or a gap was there in the window where the repo was at 375. Earlier, I just say. So earlier it was maintained at 50 basis points, then it was 40 basis points. Seriously, that 40, 50 and all do not have any sanctimony. I mean, you can have there is nothing sanctimonious, I would say, about those. Today it is at 590. And repo means government RBI is willing to give money to banks against government securities which the banks are willing to park with RBI. So the investment books of the banks come down and the RBI balance of the books go up. So you should have surplus SLR. You means the bank should have surplus SLR to borrow from RBI securitized form. And today the rate is, today means right from 30th September, the day before yesterday, the rate is 590. A 50 basis points hike was there. Earlier it was 540. Now it is 590. Now, okay, 590. Then, so the corridor essentially earlier, which I have shown, is between the repo and the reverse repo. Today, effectively, today means right from 8 April 2022. Now, I will go to one more step, MSF. Where is MSF? MSF is another 25 basis points above repo rate, marginal standing facility, where the banks can pledge their surplus SLR over and above 1% of their NDTL, which is the cap for repo borrowing, and avail money at a higher rate. And for those banks who are short of SLR, they can dip into 2% of their SLR and still avail at 6.15 MSF. So this is the levels at which liquidity is being injected into the system or liquidity is being withdrawn from the system so that call money operates within the call. Now, from 8th April, this 565 gains relevance because you have a product called Standing Deposit Facility, SDF. This will not be there in your Macmillan book, but questions are very likely because this is a new topic. Yesterday itself, I have given all the features. Still, for the purpose of revision, I'm just saying it's a clean borrowing by RBI. Banks can park surplus money with RBI in an overnight deposit facility called Standing Deposit Facility. Today, the rate is 5.6. That is 25 basis points below your repo rate. So essentially, the liquidity injection rate of repo 590 and liquidity absorption rate becomes 565, not 335 becomes redundant. And why this is not eligible for, you should not buy art. Why it is not eligible for CRR? That you should understand. Because if a bank were to maintain CRR as balances in current account with RBI, it receives no interest. If SDF balances become eligible for CRR, everybody will move their current account balance into SDF and RBI will end up paying interest. So an interest paying deposit facility is not made available to banks for maintaining CRR. That is the reason. But it is eligible as SLR because surplus CRR, if you maintain with RBI, it is eligible for SLR. Similarly, here you maintain your surplus liquidity in SDF, you take it as eligible SLR. RBI has no qualms on that. So that is the background under which it is eligible for SLR but not eligible for CRR. Now don't confuse, don't by heart, no, hey ya nahi, ha ya nahi, nothing, no confusions, concept wise be clear. Now, effectively the the LAF corridor now rests between MSF and SDF because SDF is available at 565 every day and MSF is available at 25 basis points above repo rate. Effectively, the corridor for liquidity under LAF becomes or shifts from repo, reverse repo window to MSF to SDF. That's all I want. So every rate to be clear so that you know which is lowest. Now today some of the people faltered because they thought that 1 day's default in CRR, the rate is flat 3%. Even now I am getting some responses. It is not flat 3%. It is bank rate plus 3% for first day and bank rate plus 5% for second day onwards. So MSF and bank rate are same rate today. That is because RBI has kept it at that. RBI has got the discretion also to keep bank rate at a different level. But for so many years together now, MSF rate and bank rate have been kept the same. So bank rate plus 3 is the default rate for CRR. So effectively 9.15. This is where many of you went wrong, saying that 3% is the lowest rate for as an answer for today's question. Check whether everybody has somebody is coughing, flashing of pages, everything sound is coming. Please check everybody has. Yeah. So this is what I want clear clarity. Please mute. Check your left-hand corner whether the red button of your mic appears as muted. Please check. Thank you. Now, last week we ended here, or we were to start from here about classification of government securities. Please mute yourself. Please. Somebody's phone or instrument is still not muted, please. Okay. Now, the government's investment portfolio of any bank has to be categorized. For those of you who have already started or gone through your annual report, you would have found that the investments are classified and mentioned in the balance sheet as government securities, non-SLR bonds, equities, then mutual funds, venture capital funds, then investment in subsidiaries and joint ventures, and then your derivatives naked, there is trading position if you have any naked derivatives. Otherwise, normally it goes along with whatever is underlying your SLR portfolio, or there you have a netting mechanism there. Horizontal disallowance and vertical disallowance you will be learning in module D. So that's all part of your derivative netting. Otherwise, derivatives will also be separate. Now, with that understanding, we need to be very clear that whenever a bank purchases a security, secondary market, primary market, whichever it is, whenever it is acquired, it has to categorize or record in their books under which category it is acquiring: held to maturity, or available for sale, or held for trading. So these three categories, very, very sacrosanct at the time of acquiring, not at the time of selling or at whenever you wish you can categorize. No, at the time of acquiring, it must be recorded and it must be accounted in the books of the bank on the same day the deal is done. Deal is done means for settlement. T+1 normally do. So next day, tomorrow, it should be accounted in the same category in which you have recorded it at the time of purchase. Is the dealer will work out or write out a deal slip. There he has to categorize in which category he is buying, and then immediately the back office has to account it in the same category. So that is the what is that? The discipline about categorization in HTM, AFS, and HFT. Now, what are the differences when we categorize in these three verticals or these three categories? Now, held to maturity means, as the term suggests, the intention of the bank or the financial institution is to hold it to maturity. It doesn't prevent you from selling it in between. But the general intent is long-term, to hold it till maturity. Therefore, up to the SLR requirement of a bank, you can. Yes.
No. তুমি বলছো.
Please mute yourself. Tumi Moricho, please mute yourself. Please. Okay. So, the maximum up to which a bank can hold in its HTM portfolio is up to the regulatory SLR. The next slide, I will clarify that definition wise also, but at the moment you take it as the maximum mandated SLR, you can hold it in HTM category. Now, why there is a I would say there is a thriving or there is an attraction for banks to hold it in HTM is that they need not provide for any depreciation on the bond prices which they are holding in HTM category as on the balance sheet date. Every March 31st and every other quarter also, that is your June, September, December quarterly results. If you have started reading your annual report as well as the investors analysis or PowerPoints presented by your management, there will be given what is the MTM mark to market of or the depreciation on the portfolio. So the HTM category, because the intent is to hold it till maturity, they need not be mark to market. So 2-3 weeks back, a 7.26% Government of India 2032 was issued. Today, the 10-year yield is at 7.43. The bond will be trading at 100 plus or 100 minus.
100 minus.
Beautiful. Thank you. So the bond will be trading at 100 minus, assuming it is 99.20. 80 paise depreciation has happened, which, assuming you bought it at 100 in the primary market, today, because RBI has raised the repo rate by 50 basis points and withdrawn the accommodative stance or shifted the focus to being less accommodative, That means the view of the market is that interest rates can still go up because inflation is not within the 6% permitted band under the Fiscal Responsibility and Budget Management Act. Because of these reasons, macroeconomic indicators, the view of the market is that the interest rates are going to go up, and therefore your bond, which you had bought about a month back, is now suffering a erosion in value of 80 paise. So technically, your balance sheet, you have to provide debit P&L depreciation for investment value 80 paise and credit provision for investments. But because up to your mandatory SLR, anyway, as long as the bank is going to be in the financial intermediation business, you need not, or you mandatorily have to hold this security as SLR. Therefore, RBI has given you the concession that HTM portfolio you need not mark to market. So the bank is protected from providing for depreciation so long as the securities are held in the HTM category. Now, if the interest rates had moved down and there was an appreciation, anyway, your general accounting principles, which forms your qualitative disclosure as subnotes or footnotes in the annual report, you would have stated all appreciations are ignored, notional appreciations, while all depreciations are provided for as a prudent or conservative accounting policy. Every bank would have stated this. And as per RBI's master circular on investment portfolio also, this is the direction that appreciations should be ignored, cannot be taken into P&L, while depreciation has to be provided. But so long as it is in HTM portfolio, that depreciation need not be done. So no mark to market. That is the greatest advantage or attraction for banks to put maximum investments into HTM category. But you can sell and you can book profit. There is nothing wrong. Then premium to be amortized. I will deal at length on premium to be amortized shortly. So just now I will just mention that if you are holding a bond at 102 in your HTM category and it is after 4 years going to mature, at the end of 4 years, RBI will credit your account with 100 rupees for redemption and 2 rupees you will have to debit P&L as redemption loss. Now, after 4 years, you may not be the MD. Somebody else will be the MD. So you will say, jitna bhi hai, 102 ka security kharid ke rakho. Then the point is you are shifting a accumulated loss to be accounted at the end of 4th year. In order to avoid such huge variations in P&L on account of redemption of premium securities, Reserve Bank of India has mandated that whatever is the premium on the HTM category security, that should be written down every year uniformly over the residual term. So 4 years is the residual term, 2 years is the premium. Every year 50 paise you reduce from the book value. So that every year your P&L you are debiting 50 paise, and in the end when it is redeemed, your book also is showing that security only at 100. So when if 3 years you are the MD, 1.5 rupee depreciation you take in the knock, and the 4th year new MD takes another 50 paise. So these are all the boardroom gimmicks as well as the uniformity, so that the investor who has invested in your stock, SBI stock at 550, he also is not sitting on a shock that there is going to be a huge redemption loss to be taken as a one-time knock. No, it is distributed over the residual term. Only if the premium discount anyway will come to you as profit on redemption, so that is ignored. So premium, and this has to be amortized debiting to the interest account. That I will be clarifying later. Just remember, charge to interest, I have already put it there. And the profit you make from bonds which are categorized in HTM category have to be shifted to an investment reserve account. You cannot make it available for free distribution as bonus, dividend, or things like that. Only from AFS and HFT, whatever profit you make, you can distribute as dividend. But whatever profit you make from selling bonds from HTM, you have to shift it to or transfer it to a investment fluctuation or investment reserve account. And whatever sale your bank is doing in a year, above 5% of the total HTM portfolio, you have to disclose it under Pillar 3 of Basel in your annual report that we have sold securities from HTM amounting to say 8% of our HTM portfolio or 10% of our HTM portfolio, and the profit booked from therefrom is so much. So this will also give the investor an idea whether you are selling stocks that have been acquired 10 years or 5 years back and making a profit to cover up for huge NPAs that are coming up or, or things like that. So, but for urban commercial banks, this sale from HTM is not permitted. Only for scheduled commercial banks, this is permitted. So that is the description about HTM. Now turn right, extreme right to HFT. I will discuss HFT because the remaining is in AFS. So once you are clear about HTM and HFT, AFS is very simple. So let us focus for a brief while first on held for trading. Now, the held for trading category, as the name suggests, is mostly with a short-term view. The dealer decides that there is going to be some volatility. Biden is going to shout something, or Shaktikanta Das is going to shout something like that. Your intuitions, all this is recorded in several books by dealers who have spent, years together interviewing dealers across commodities, across markets, across geographies. The Market Wizards, okay, Jack Schwager, that book, very interesting book. So again, the held for trading is essentially a dealer's portfolio, and the maximum holding period for a stock in HFT is 90 days. It can be a government stock, it can be a non-SLR bond, it can be an equity share. Everything you can categorize under the held for trading category for maximum 90 days. So this 90 days maximum permissible holding period in HFT is called a defeasance period. And these securities which are acquired in HFT category could be marked to market daily, and the stop loss trigger will be monitored by back office and mid office. Front office will also have to monitor because otherwise they will be pulled up for breach of policy. And at the end of 90 days, if you are not able to book a profit and come out, or not able to book the loss, but you want to continue it, please mute yourself. Konju idea, Tamiz Chefpa, please mute yourself. Konju idea, please. Thank you. So if you want to hold on to the security, you can shift it from HFT to AFS. Shift it at today. The shifting dates lower value. Why you did not book a profit? Because there is a depreciation. So you can shift. You bought it at say 99.80, and it is today selling at trading at 99.60. This 20 paisa you don't want to book the loss, but the market you have held it for 90 days. So you can shift it to AFS category at 99.60 and charge that 20 paise to your PNL. So that is the moving to AFS at lower of market value or book value. And that 20 paise loss has to be booked on the date of shifting. So this is essentially the characteristic of HFT. And as per your bank's board policy, how much you can hold it in HFT, that is the bank's decision. RBI does not come into the picture at all. Now AFS. So whatever is not there in HTM and whatever is not there in HFT will be in AFS. It will be marked to market mandatorily every quarter. When you declare the quarterly results, it has to be marked to market. But mostly banks do it at least monthly. And it is freely traded. You can have all non-SLR securities like your Ashok Leyland Finance debenture or L&T debenture or Adani Corporation's debenture. All this non-SLR will come only in AFS. In HTM, only SLR category can be. Equity will come, mutual funds will come. And at the beginning of a year, every bank's board has been given the permission to shift from one category to another, depending on their needs. From HTM also, you can shift to AFS at the beginning of the year. That is a one-time shift. So every year, if you can see, your annual report will also mention about the shifting that has been done. So this is all about the categorization. Now, in some more detail, we will find out some of the nuances of this categorization, especially HTM. HTM, the RBI circular, the limit is 25% of the investment portfolio, but up to your mandated SLR, you can hold even if it is above 25% of the portfolio. So, this has been increased to 19.5 and 22. That's all incidental, just to cover up, because somebody will come up with a circular and tell me, sir, 19.5 here. So I'm putting it now itself, including the circular number. So this is to encourage banks to hold more stocks in HTM, so that the government borrowing program is also well supported and the yield does not go up. Okay. And it will be brought down progressively to 19.5 by December 31, 2023. So that is all macroeconomics, not much important from an examination point of view. And these stocks should have been between 18% to 23%, that extra 5% you should have acquired, the bank should have acquired after 1st September 2020. So that the incremental borrowing program of the government is supported by the banks. Now, what is this 25%? Suppose NDTL is 1 lakh and 18% is SLR. What is SLR required now?
18%.
18%. 18%. 18%.
हाँ 18% मैंने बोला. So कितना amount है?
180 crores. 180 crores, sir.
18,000 crores.
Okay. Okay. Now, suppose SLR is 28.
I have one doubt.
Let me complete this. I'll come back to you. Your name?
Shankar Narayan.
I'll come back to you. Give me time. Now, suppose your bank's investment portfolio is SLR is 28,000 crores. So, there are two caps by RBI. 25% of your investments. This is the first cap, that the HTM maximum can be 25% of your investments, which is 7,000 crores. Also, your regulatory SLR 18% means 18,000 crores can be your regulatory SLR that can be categorized in HTM. So you need not mark to market. So though 25% of your SLR is only 7,000, practically for your bank, your limit becomes 18,000 crores. Yeah. Now Shankar Narayanan asked.
Sir, if SLR reduced by 18 to 16%,
Yes.
I have to sell my 2% STM category.
You need not sell so long as you don't have a liquidity problem. You can easily hold on to SLR. There is no
Because of maximum limit up to SLR percentage.
maximum limit. RBI does not say. Under the Banking Regulation Act, RBI can prescribe maximum mandatory SLR at 40%. Your bank is at free will to hold even 50% as your SLR portfolio. That is your bank's decision. There is no restriction.
Okay,
Good
okay, okay.
Good question. Okay, but only if SLR reduced from 18% to 16,000, in HTM you can hold only 16,000. That is the catch.
Sir,
Clear?
I have a doubt, sir.
Please.
Sir, SLR to be 18,000 crores, but why is it 28,000 crores there, sir?
28,000, I have not said SLR. I have said SLR portfolio. I will change that heading. Investment portfolio is 28,000.
Okay.
That is, yeah, investment portfolio. Okay. Out of that, HTM can be only 18,000. HTM can be only 18,000.
Okay, okay, sir.
Good question. So this is the interpretation of RBI circular. How you, what is it? Make the operative cap at 25% of investments or your regulatory SLR. For practically for every bank, it will be the regulatory SLR which will be the cap. Then operating cap will be 18,000. I have already. Now post-COVID, now it is 22,000 crores and even 23,000 crores. So long as it is 1 lakh, please mute yourself. Somebody is having a private discussion at home. Please mute yourself. Yeah. So effectively, your mandatory SLR will be your cap for HTM. So that is one thing. Now amortization. Now book value of a security is 108 in HTM with residual tenor of 4 years. So what will be the per year amount you have to reduce?
2
That's
rupees.
all. Come on, be confident. 8/4. I will ask maximum only 5th standard arithmetic. Maximum. Okay. 8/4, 2 rupees. So every year you have to knock off 2 rupees from this 108 so that at the end of the 4th year, it becomes 106, 104, 102 and 100. So that is the concept. So amortize 2 rupees each year so that by end of 4th year, book value will be 100. So every MD who sits during the 4 years will take a depreciation knock of 2 rupees. And the depreciation knock is charged to interest account. Be very clear. Okay. Where do I debit my amortization charge? Amortization charge is debited to interest account on investments. Because what? Why there is a amortization? Because the coupon on the bond is high. So your bank is enjoying a high coupon, maybe 783 or 825 like that. When market interest rate is say 6% or 6.5%. So because of the higher interest, higher coupon, you are enjoying the coupon by paying a premium on the bond. So you debit the interest account so that your interest account is also not distorted. Now, otherwise, these are some of the distortions through which your bank can mask a poor financial position by buying too much premium bonds and enjoying a high coupon and then showing your spread is high and all. So these are all or NIM, more than spread NIM. So this is where that, what is it? Counter checks from RBI are in place. Interest account, please remember. Now, government securities, including state development loans, one category. I have already said this, including state development loans, because when we come to market, within these permitted categories, one appreciation and another depreciation you can net off. But not, I'll explain it shortly, but not between two categories. So, your other approved securities, that is your maybe earlier on a NABARD bond or an IDBI bond would be an approved security. So government securities, central government as well as state loans and other approved securities make your SLR portfolio. Then shares, debentures and bonds. These are not SLR. Then subsidiaries and joint ventures, others, venture capital funds, mutual funds, and then I said derivatives. So what I wanted to clarify now itself is that the appreciation in your share, one share you can knock off against the depreciation in another share. The appreciation in one mutual fund, you can knock off against the appreciation or depreciation in another mutual fund. But the net appreciation in share, you cannot knock off against net depreciation requirement in your SLR portfolio, government securities, or the net depreciation required in your debentures and bonds, non-SLR. So like this, whatever each particular category's depreciation requirement is there, that has to be added up and provided as a debit to P&L, depreciation on investments every quarter. One category's net appreciation cannot be netted. But within the category, appreciation in one share can be netted against another share's depreciation. Appreciation in one government bond can be netted off against the depreciation in another government bond. That is the
At last,
clarity.
sir, debit is happening to one account only, the same account, interest account.
Yeah, debit is happening to one account only, depreciation on investments. Correct. Correct. I'll clarify that. MTM slide is coming, so you will get more clarity. So now, this is the MTM representative of one of the investment portfolio I put here. Now, HTM need not be mark to market. I have already clarified. Held to maturity need not be mark to market. So available for sale and HFT together, these are 4, 5, 6 government securities, including one state development loan. So government security need not be Government of India. Government of India plus state development loans both come under SLR. So you are holding it in your books 396 2022 at 98 rupees, 515 2025 at 101 rupee, 717 2028 at 99.20, 577 state development loan Tamil Nadu 2030 at 101, 585 GOI 2030 at 102, and 622 GOI 2035 at 103. So these are your book value. Your total portfolio is 604.20 crores. Okay. Now, as on March 31st, the closing prices given out by Financial Benchmark India Limited, FBIL. FIMDA, FIMMDA is the self-regulatory body. FBIL works in close association with FIMDA and comes out with the last traded price, so that whether you are Federal Bank, whether you are Canara Bank, whether you are SBI, 396 2022, everybody puts 99.50 as the closing price as on 31st March. Uniformity, because FBIL is coming out with the closing price. So 98 rupees you are holding, 99.50, 1 rupee 50 paise is your appreciation on that particular bond. On the second bond, you are having a depreciation of 3 rupee 20 paise. On the third bond, you are having an appreciation of 5 rupee 90 paise, while fourth, fifth, and sixth bonds you are having depreciation. So the appreciation on 1 and 3 bonds can be netted off against the depreciation on 2, 4, 5, and 6 bonds, because all the 6 are in the SLR category. So the net depreciation is 10 crore 30 lakhs, which has to be provided, debited to your P&L. Now, my discussion is not over. Similarly, your bank is holding in your HFT or AFS category shares, equity shares. Infosys, you are holding at 720, today trading at 1340, 620 rupees gain is there, appreciation. Maruti, you are holding at 8,000, today trading at 7,600, 400 rupees depreciation is there. Pfizer, you are holding at 4,000, today 5,200, 1,200. So effectively, all the 3 shares put together, your bank is having a cumulative or net appreciation of 1,420. You can net off the depreciation of 400 in one share against the appreciation available on the other 2 shares, and net appreciation should be ignored. So this 1,420 you cannot net it off against 10 rupee 30 paise. That is the clarity you should have. Within one category, you can have net appreciation and depreciation, but inter se category, wherever there is a depreciation, that has to be vouched. Wherever there is a net appreciation, that has to be ignored. Similarly, for mutual funds, for subsidiaries and joint ventures, everything will be same way. Now, total market risk charge, therefore, for your bank, as per this closing prices, is 10 crore 30 lakhs. So that you debit to P&L and credit provision account 10 crore 30 lakhs. This is the concept of marking to market. Marking to market is done by the mid office and the vouching is done by the bank.
So how we will identify that these all are in SLR category?
How will you
identify that all these are in SLR category?
At the time of acquisition itself, you have to categorize whether it is HFT, HTM, or AFS. Similarly, whether it is SLR, non-SLR, equity, mutual fund, subsidiaries and joint ventures, like that, which category you are going to hold it, you have to categorize. So long as the issuer is Government of India or a state government, it is an eligible SLR security. Have I answered you?
Yes, sir.
Good question. So this is all about marking to market. This will be
Sir,
dealt
one
in.
question, sir. If
Please.
if it is not government, then it will be
Not as a law. If it is a bond, if it is a debt and it is not government, it will be not as a law. If it is a share, it will be equity separately. That will also be not as a law.
okay, sir.
Good. Very good. So this is how your categorization and the treatment or incidence of depreciation on each category reflects in your P&L. Good. Now about 2-3 slides on what is your payment and settlement group and the mechanisms. You will be covering this more in your retail banking paper also. If you are some of you who are taking that paper, it will be there about your payment products and all UPI and all. But I will cover that. Payment and settlement group. Every bank has got now a payment gateway for your NEFT and RTGS, which is now 24/7/365. So the entire world is looking at RBI and NPCI, National Payments Corporation of India, as to how this has been made so perfect and seamless and straight through processing. Such a product has been launched. So every other kind, already more than 96 countries are accepting our RuPay cards. So all this credit should be given to the payment mechanisms. So these are some of the main products, UPI, which is making revolution, I would say. Now, RTGS is gross settlement, real-time gross settlement, and NEFT is net settlement. Okay, National Electronic Fund Transfer, but it is net settlement. Now, what is the difference? We'll be covering when we cover DVP also. You will get more clarity then. But still, I will say RTGS means transaction by transaction. 500 crores is being remitted by SBI to Canara Bank. 500 crores RBI account of SBI is debited and Canara Bank's RBI account is credited. Simultaneously, Canara Bank makes a RTGS remittance of 300 crores to SBI. Second time, Canara Bank's RBI account is debited with 300 and SBI's account is credited with 300. If this were to be under NEFT, then 500 minus 300 net is 200. So SBI's account will be debited by 200 and Canara's account will be credited with 200. On a batch settlement basis, every 1 hour the batches are run. So RTGS then and there the transactions.
Now, sir, half hour batches, NEFT.
Now half an hour. Okay, thank you. Correct. Thank you. So now half an hour, every half an hour. So this happens. Very good. So it's a batch settlement process. MNBS, multilateral net batch settlement, MNBS. Okay, very good. Now, why a gridlock should happen? Suppose SBI's remittance of 500 crores to Canara Bank. And then Canara has to make another 3,000 crores of remittance to, say, South Indian Bank. And then South Indian has to receive this 3,000 to make a remittance of 2,200 crores to UCO Bank. Now, if Canara is not able to give that 3,000 crores immediately to South Indian, being a small bank, South Indian may not have adequate balances to originate a 2,200 crore debit to you in favor of UCO Bank. So that's a transaction gets gets blocked in the queue, and this is what is called a gridlock. And wherever a specific bank is having a gridlock, there is temporary mismatch of cash flows, they can approach Reserve Bank of India for intraday liquid loans, intraday liquidity loans. So these are charged now not on an interest-bearing basis, but purely as 25 rupees per transaction or something. And ideals are you can avail, your bank can avail from RBI and credit that amount to your settlement account, and then that gridlock, that queue can be released. So that is the mechanism to avoid gridlock.
Excuse me, sir. Excuse me, sir. Sir, you are talking about the gridlock, no? So, like in an account, when there is no fund, like it's not that they will wait from where funds is coming, then only it will be remitted. When fund is there, then only those situations happen. No, I have not understood.
No, your question is that the
You were like,
debit
you
of
were saying, no, you were saying like 3,000 crore will come, then they will be able to remit that fund to another bank. But
correct.
it is the situation like when there is fund, then only we do the RTGS and all. No,
When
like
there
we
is
don't wait. No.
no, 1 second. We will analyze this in 2 stages. If I have not understood your question after the 2 stages, please clarify me. First thing you are saying is, suppose it is whom you want. Larsen and Toubro has to make a remittance of 3,000 crores. Who is maintaining his account with SBI? To Canara Bank. Okay. So what you are saying is, unless there is 3,000 crores of money in Larsen and Toubro's current account, this transaction will not go through. Am I right?
Yes,
The
sir.
first.
Yes,
Okay.
sir. Yes, sir.
Good. Now, in current account of Larsen and Toubro, this 3,000 crores is there, and SBI has debited. Okay, but that transaction has to go to Canara Bank only if there is 3,000 crores of balance in current account of SBI. Suppose that balance is not there, it is because already a Ministry of Defense huge payment has been paid from that current account with the RBI. So SBI's balance is not there. It has to wait for some other transaction to come in, money to come in. So though the constituent Larsen and Toubro's account is having money, from one bank to another, the RBI current account is in deficit. That is why the fund has effectively not landed in the receiving bank's current account with RBI. Now, is it clear for you?
Yes, sir. Yes, sir. I have
Beautiful. Beautiful. So this is why, though constituent's current account has balance, the bank has to approach RBI for intraday liquidity. Now, gross settled. So RTGS, there is no reversal of transaction finality. And NEFT net settled. Outward 100 crores, inward 170 crores. One credit of 70 crores is what is a net settlement. Just an example. Not much, but you should know the concept, because especially in the other paper also questions can come. So why this happened or NPCI came into a picture? RBI has been donning multiple hats. Earlier, even now, because of these multiple hats, there has been governance issues. SBI, RBI was a major shareholder till about very recently, maybe about 10-15 years back. They completely divested from SBI and became a non-shareholder. They were till then a shareholder, and they were having direct on the board representation also. So a regulator sitting on the board of a regulated entity was having a conflict of interest and governance issues. Therefore, RBI now has moved away from all direct governance of banks by sitting on their boards. Only when somebody is under prompt corrective action or things like that, these kind of things happen. Okay. So that is about. Then divested completely. Then RBI was having earlier I'm saying regulated interest rate regime. Every bank will come out after the monetary policy is announced. My 7 days to 15 days deposit rate is so much. My 1 year to 2 year deposit rate is, and it will be the same. It's for the scheduled commercial banks, because everything was regulated by RBI. Now everything is deregulated except your differential interest rate loan schemes for the lower income group, not lowest income group. That is just a representative scheme only. 4% is the mandated interest rate. So otherwise, even savings bank interest, आपको 8% का खाता खोलो, like that messages are coming from Kotak Bank or other DCB Bank and all. So everything is free now. So this has improved the transmission channels of monetary policy. Time permitting, I will revisit that point later. Not important from an examination point of view. Then government issuances, earlier RBI was underwriting, which was leading to monetization and inflationary effect. Now only primary dealers are permitted to underwrite government auctions. Every week auction is underwritten by the primary dealers under the Fiscal Responsibility and Budget Management Act 2003. Then Reserve Bank note issuances, they transfer to a separate entity, Reserve Bank Note Mudra, Bank Note Mudra Private Limited. Then all the government securities, foreign exchange trades, etc., are now settled on the NDS platform. So IDRBT was first formed, and they provided the backbone, the Infinet, the network, closed user group network, secured network for all financial institutions, just like your SWIFT. This Infinet was launched by IDRBT so that CCIL, Clearing Corporation of India Limited, could launch or enable delivery versus payment. That is being discussed individually in another slide. Then even research relating to economics now in Indira Gandhi Institute of Development Research, like the green meadows of Goregaon, you will find in Bombay, Indira Gandhi Institute of Development Research. There even RBI has promoted chairs for research. So everywhere RBI is now disengaging itself from direct control, and National Payment Corporation of India transformed the payment ecosystem with the implementation of the Payment and Settlements Act 2007. Okay, now the delivery versus payment, why it is important for a bond trader like us, or from a BFM perspective, what it was not there earlier, delivery versus payment can be seen by this, what is it? 1 second, yeah. Can be seen by this Harshat Mehta's scam. Okay, what happened around 1993, 94 and all, or 92. So some of you may not be aware what happened, but who is interested can go through this book, The Scam by Debashish Basu and Sucheta Dalal. It's a very, very interesting chronicling of what happened during those days, which led to fictitious money being created that was funneled into the stock markets, and stock prices were taken to dizzy heights, and people speculated very heavily. Banks lost out, many of them is BR, bankers' receipts and all, everything, all that happened is recorded in this book. So after your examination, maybe you can buy it in the bank's library and read it. Now, the IDRBT, what they provided, this Infinet is a closed user group. So like your virtual private network, VPN network, how you log in for work from home and all, this is again a closed user group. So through the digital certificates now they are providing, and all this SFMS, that is a grammar. When you talk 5,000 rupees debited, this debit means what? And whether debited means constituents account or your current account. All this grammar has been structured through this structured financial messaging system. Like a SWIFT message, when you open an LC, you have to follow certain norms of certain specific words, and under specific certain fields, like payment, outward payment message 102 MT 101, MT 201, like that. There only you can put a payment message. LC means it's a MT 701. Similarly, all this grammar is codified under SFMS. So even an RTGS message, you process it under certain fields. Who is the beneficiary will be mentioned not at the end, some specific field. And there is no love letter in this messaging. There is no I love you, how are you, and things like that. That is all different. You send a 999 unstructured message in SWIFT, that is a love letter, but not this kind of business messages. So that is, they follow ISO 222 standards. And this national financial switch enabled or facilitated the linking of ATMs. So with an SBI card, you go into a UCO bank or an Indian bank or even a white label ATM and draw money. So linking of ATMs. And then Infinet. And this has been now manned by our IDRBT, handed it over to IFTAS, who manage the Infinet and the NFS now. Now, yeah, Payment and Settlement Systems Act 2007. Therefore, this national financial switch was taken over by NPCI on 14th December 2009, and IMPS, immediate credit, is now 24/7/365. Yes, there are certain risk management architecture behind it. It is not that immediate payment means how it is guaranteed if the bank fails. All that is settlement guarantee fund and all are there. We will discuss that when we come to DVP also. Yeah, multilateral net back settlements regulated by RBI. Section 8 company, not a special purpose vehicle. Section 8 company means not for profits, like your FEDI, like your FIMDA. These are all earlier, before 2013 Companies Act, Section 25 company. Now it's a Section 8 company. In case a casual question comes in objective, you should know what is a Section 8. Now, some of the products I'm just running through, Aadhaar enabled payment system, all your direct benefit transfers and all are going through the bridge. And then check truncation, you already know now there is no clearinghouse. Checks you only do through imaging and check truncation. Then RuPay is the domesticated card payment network, so that all the data first remains within India and the money also moves around within the country without making payment to Visa or Master. And this is where I said RuPay is now accepted in more than 96 countries. We have covered this RuPay mechanism alone in our 2 issues of Vigyan previous month and the month before that. So somebody who is interested can go through that also. Then all your e-mandates, e-credit and e-debit mandates are going through this NACH, and this bridge is for direct benefit transfers, and your FASTag, all collections are going through NETC. And now when you have a cola or a, tender coconut, you make the payment through the QR code which he has stuck on the coconut. So that is all Bharat QR, and then UPI and BHIM. All these are some of the products for familiarization I just mentioned. Now, what is the difference between RBI and the other one? Okay, account number and IFC, so pure interbank standardized, and core banking solutions is your backbone security. Whereas in your mobile phone, you can create virtual address, so an Aadhaar or IEMD number and all that mobile number and account number plus IFC that is there. But this is customizable. That is where your Paytm and all those people come in. And then non-bank payment service providers. Now RBI has come in on a big way because these Chinese people were moving away with a lot of money. So there is a push and pull, remit and collect. But for collecting, you should not give your OTP, phishing, smishing, everything. 2-factor authentication. Yes, one is a device fingerprint, another is a machine address code. I already mentioned about IMED number or something. Then there is a transaction PIN. So this OTP is a 3rd factor. This is just to cover the discussion. Now, just see how you, please.
Sir, please define APBS for DBT.
DVP, delivery versus payment, I'm discussing in one slide separately. Please wait for your doubt at that point.
Okay, sir.
Please. It's coming shortly. Now, how UPI has taken over NEFT, I have just given for May and June 2020 the figures. So this IMPS has overtaken RTGS and NEFT by miles or leaps and bounds. That is just a CCIL data. Now, CCIL operates or provides the platform negotiated dealing system, order matching, which is on the eKuber. That is the proprietary core banking solution of RBI, eKuber. All auctions, everything happened there. Yes, including your LAF, repo, SDF, everything happens there. And TREPS also happens on CCIL. And FX Clear is another product. If you log into CCIL and see, there will be F-Track for your CD, CP and all, and there will be FX Clear for your USD, INR and other cross-currency trades. And they are reported for settlement on a net basis on CCIL. And we have the back-end depositories where your CD, CP or equity shares are all held. The main 2 depositories are National Securities Depository Limited and the Central Security Depository Limited. So question comes means you should be clear. CCIL is a common counterparty and a clearing agent, whereas NSDL and CDSL are depositories. Now somebody asked about DVP. Now this is one transaction we are trying to find out through what is DVP. Earlier, before DVP was there, what was happening was SBI buys bonds 25 crores from ICICI. So SBI will give an RBI check for 25 crores, which the ICICI peon will lodge it in the public accounts department of RBI, the first floor or second floor in a dilapidated building on the Amar building on the Shahid Bhagat Singh Marg Road in Bombay. Now, 25 crores of government securities ICICI has to transfer from its SGL account, subsidiary general ledger account, to SBI. So they will issue an SGL form, which will be again taken by the peon of SBI and lodged in the 25th floor in the public debt office in the new administrative complex building in the same Shahid Bhagat Singh Marg, but opposite the Amar building. It's on a different floor and a different building. So this current account, when the check is passed, this man does not know whether there is 25 crores of securities with ICICI or not. And the man in the 25th floor who processes the SGL form is just like a checkbook issued on the SGL account, that's all. So when 25 crores of government securities is to be debited from ICICI account, he is not aware whether there is 25 crores of good balance in current account of SBI, whether the buyer has got money or not. And this knowledge gap was what was exploited by what is his name? Harshad Mehta in this scam. Okay, so now both are linked electronically. So what happens? SBI should have in current account minimum 25 crores cash at the time of concluding the deal, and ICICI should have in their SGL account minimum 25 crores of securities for concluding the deal. So CCIL is an order matching system. When the deal is put in by SBI and ICICI and the prices match, first thing it verifies at the back end is whether there is sufficient cash in SBI's account and whether there is sufficient securities balance in ICICI's SGL account. This is done by Clearing Corporation of India Limited. They come in as a middleman, as a trusted agent, a common counterparty to both persons. And this concept is called Yagala Santeka, raised hand. Yes. You want to ask a doubt or you accidentally raised the hand? Okay, looks like accidentally. So, what we need to know is this becoming a common counterparty is called the concept of novation. Novation. Concept of novation means stepping into the shoes of the buyer for the seller and stepping into the shoes of the seller for the buyer. So that stepping into the shoes of the common counterparty is the concept of novation. And therefore, now once CCAL permits the transaction to be concluded, what happens is 25 crores of money moves from current account of SBI to current account of ICICI, and simultaneously 25 crores of securities move from SGL account of ICICI to SBI. Now, is it clear? DVP, delivery versus payment. Somebody is damaging my screen. Please, all red lines coming up. Please. Yeah. So this is what you should be clear about. What delivery versus payment is ensuring that there is no counterparty risk or a settlement risk, operational risk about settlement not going. Hey, Venugopala, please don't disturb my screen, please. Yeah. So this is about delivery versus payment, so that settlement risk is avoided, counterparty risk is avoided. Only if there is clear cash balance and clear securities balance, this CCIL transaction, CCIL permits the transaction to go through by becoming a common counterparty or central counterparty through the concept of novation. And how they operate or give you a guarantee of settlement. They guarantee the settlement, whether it is trade is done by Punjab and Maharashtra Cooperative Bank, or say a Development Credit Bank, or a Development Bank of Singapore, or SBI, the trade is guaranteed by CCIL. MV Savita, yes. Any doubt? It's okay. So this is the how they ensure the guarantee the settlement trade will happen is when they admit a member to the CCIL, they ask for settlement guarantee fund contribution. And if it is SBI, depending on the volume of trade that an average SBI does, they are asked to lodge, say 5,000 crores is their average turnover in government securities on CCIL platform. They will say 5%, 10% is 500 crores, so say 250 crores, and another 250 crores you deposit as cash. Suppose they will say. Similarly, a DBS Bank, Development Bank of Singapore, DBS Bank may be having a turnover of only say 100 crores. So you deposit 5 crores plus 5 crores as your settlement guarantee fund contribution. There is no sacrosanct about this 5 or 500 and all. It is prescribed by CCIL depending on the volatility in the market. On a single day,
Hello,
suppose,
sir.
yeah.
The screen is not clear, sir. Ask them to erase the lines, please.
That is Venugopal Rao. Please erase the lines. Please erase the lines. Okay. So now I think maybe next slide. Let us see what is it goes out. Otherwise, I'll come share the screen once again. I'll stop share and come back. 1 second. Now, so if one day DBS Bank wants to put through transactions for 500 crores, whereas they have given settlement guarantee fund contribution only for 100 crores, they can still put it through by pre-funding the account. Okay, that means for 500 crores, you put the money upfront with CCIL or the security upfront if you are a seller, upfront with CCIL, then that trade will go through. So this is how the counterparty risk is avoided by Clearing Corporation of India Limited. This principle is called novation, and call money, government securities, forex spot, and forex forwards are settled on the CCIL. Now, euro dollar or euro pound deals and all, or USD JPY deals, cross currency deals are settled on the continuous link settlements of SWIFT mechanism, that is through the payment versus payment mechanism. Here it is delivery versus payment. There it is one currency against the other. So it is called PVP. Okay. Okay. Now let me stop here and come back so that if this goes out, it will be better. 1 second. DVP. Okay. 1 second. Yeah. Better now? Yeah. So now DVP also went through a gross to a net process, DVP1, DVP2, DVP3. That's for understanding. Sometimes we don't know what level the questions will come. So concept-wise, earlier DVP1 means both securities and funds were settled on gross basis. DVP2 means securities and funds were settled, securities on gross and funds on net. And DVP3, which is in operation now, both are settled on net basis. Now, how do you understand the impact from a trade? Suppose you buy securities for 50 crores and sell the securities, same security for 20 crores the same day. Both are to be settled tomorrow, T+1. So your SGL, when you buy, will get credited with securities 50. And then when you sell, 20 crores balance should be will come into your current account. Now, under DVP1, first both 50-50 will happen, and then the 20-20 will happen because both are on gross basis, like your RTGS. Under DVP2, securities is on gross. So first 50 will come and then 20 will go. Whereas funds is on net basis, minus 50 plus 20, net is 30. So only one debit of 30 will be. Under DVP3, there will be only two entries, one plus 30 in your SGL and minus 30 in your current account. So this is essentially what is this net and gross difference. how it impacts your this one. 1 second, let me just open the door. Sorry. So now we will also look into some of the risks per se of treasury. In your D module, this will be more dealt in detail, but still you should know what happens module wise the questions. How there can be huge losses. Nick Leeson, Barings Bank, front office and back office colluded, and 100-year-old bank was sold for 1 shilling. You know the story. Yeah, it's coming here also. Yeah, sorry. So organizational controls are required. That is why front office, mid office, and back office are separately compartmentalized, and only mid office has got free access to both front and back. Otherwise, the inter se access is not there for front and back. Now, exposure ceilings. In your policy, each bank's policy, there will be an exposure on equities, how much your bank can trade. There will be an exposure on non-SLR trades or portfolio. And what will be the duration of your portfolio, weighted average duration. Duration means not residual tenor. Last week, we discussed 2-3 tough questions. I repeatedly kept on saying it's not residual tenor, but it's a measure expressed in number of years. It captures the price volatility of the bond. Okay, so longer the tenor, higher the duration. So maybe Canara Bank may afford to hold a portfolio duration of say 6.5 years, whereas a KARUR VYSYA bank or even a DBS bank or a DCB bank would like to restrict it to say 2 years or 1.5 years, because huge MTM depreciation risk comes means they may not have adequate profits to provide for. So sector-wise, infrastructure sector, how much we should have taken exposure, credit also, investment also, or the maturity-wise I have already told. So like this, exposure ceilings will be there. Then position limits and stop losses per deal per month. What is position limit? We'll be covering shortly. Or in detail, it's dealt in A module also, but we'll be covering it. So come to positions there. Now, what are the risks? You should be very clear, because objective question, everything says most appropriate choice. So liquidity risk is a all-encompassing risk. But when it comes to one particular transaction, it may have a different aim. So that is why I am bringing in all these terms here. So liquidity risk and funding risk, and then position risk, we'll discuss in detail position. Please hold back. Now, what is a position? Now, you have a daughter, you want to give her in marriage 20 years from now. So will you keep accumulating gold now, or will you buy it outright in 20th year? Both are possible.
Starts now only, sir.
Sorry?
Starts now only for the
starts now only. Very good. Starts now. So the moment you start acquiring gold in small quantities, say 100 grams, 1 gram, like that, you are building a position in gold. That is, you are getting long. You have a position in gold because you have a requirement coming up after 20 years. So you tend to build a long position in gold over the period of 20 years. Each year's bonus, let me invest at least some part of it in gold. So you are building a long position. Now, you bought 1 gram, 5,000 rupees. Today it is 3,800. Are you happy or are you weeping? Happy or unhappy?
Unhappy, sir.
Unhappy. So again, position. When you are long on a position and the asset value, underlying asset is gold here, asset value comes out, spot value comes down, you are unhappy. You start providing for depreciation. If you do a mark to market. Now, in the house, you don't do it. You simply keep it in the locker. It's a different issue. But in the bank, if I have bought a Maruti share at 8,000 and today it is 7,800, I have a long position in Maruti and 400 rupees is my, 7,600. 400 rupees is my depreciation on the position. Okay. On Maruti's position. So that is why, that is what is the concept of a position. If any change in exchange or interest rate affects your balance sheet, there is a position. Interest rate means price, market price. So even in Maruti share, you can have a price change, which is called a position. Now, how do we define a position, especially for your foreign currency to Indian currency? Your bank takes a foreign currency deposit of 1 million and parks it as $1 million in your nostro balance abroad. So your liability is in dollar, your asset is in dollar. Dollar touches 80 when you did this, and tomorrow it touches 85. Do you have any anxiety?
No, no.
No anxiety. Very good.
No.
No position. Because no position, no anxiety. $1 million you are having in dollar itself in your nostro account. You can use that to repay your depositor liability. Now, $1 million liability, you give a $1 million foreign currency loan, PCFC in dollars. Are you happy or unhappy if dollar moves from 80 to 85? Either way, you are neutral. Okay, no position, neutral. Because asset and liability are same currency. Now, you do a rupee bill purchase by selling the dollar outright, and at INR, USD INR 75, 7.5 crores you got, which you discounted a bill. So your asset is in rupee, liability is in dollar. So in dollar, you have a short position because you have sold $1 million in the market. And then dollar touches 80, you start worrying. So a position affects your balance sheet the moment there is an exchange rate movement from 75 to 80. So this is a position. Now, what is net open position? It's a risk measure approved by the board. You can have an overbought, over and oversold position. Think of USD INR. So dollar you can be long or dollar you can be short. A long and dollar appreciates from 75 to 80. Dollar appreciates, you are happy because you have bought dollar at 75 and today you can sell it. Yesterday you bought it at 75, today you can sell it at 80. So underlying dollar appreciates. Similarly, gold appreciates from 3,800 to 5,000. You are happy. You are long in gold and gold appreciates. So just the same thing. So objective question can come like that. And concept wise, if you are clear, you need not by heart anything. You can work out the answer in front of the screen. Short and underlying appreciates. You are again you sold dollars and underlying depreciates. So dollar moves from 85 to 80. What you sold at 85, you can buy back at 80. So again, you are happy. So depending on whether you have a bearish view or a bullish view, you can have a long or a short position. So you are long in USD at 72 and dollar appreciates to 75. Dollar, not rupee. Clear? 3 rupees, you are in the money. Similarly, dollar depreciates from 72 to 70. Then you are again making 4 rupees. So this is about net overnight open position limit. One risk measure that question can come. What is net overnight open position limit? What is spot? In foreign exchange is T+2, not a spot death in an accident. Mahesh.
Yes, sir. Sir, what is the long position and short position?
Yeah, I'm coming to that very shortly. Please, I will explain once more. Please. If it's not clear, you can ask once again. Then, spot I have told. What is duration? Duration is not residual tenor. It's a weighted average time period taken to recoup from the cash flows of the bond, the present price of the bond, that definition, whatever it is. Leave it. It's an interest rate measure in years. Similarly here, net overnight means not the net of the short and the long. Not. It's not the net of the short and the long. Okay. So Mahesh asked now, what is this long and what is this short? I am giving this table here. You are long for $3 million in USD, your bank. Whereas your bank has sold British pounds for equivalent US dollars 2 million. So you are 2 million short in pound. And similarly, you have sold euro for 5 million. So what is the total long positions? Dollar long 3. What is the total short positions? 5 plus 2, 7. Whatever you have sold is your short position. So somebody please mute, please mute. The child is making some noise. Please mute. Yeah. So 5 and 2, 7 million you have sold in pound and euro. So the aggregate of long is 3, aggregate of short is 7, your higher aggregate is 7. That is your net overnight open position 7 million, not 7 minus 3, 4. Please, be very clear. Have I answered you, Mahesh, now?
Yes, sir.
Clear, sir.
Thank you. Now,
The concept
why
It is
this
vice
is...
versa, sir.
Sorry, one second. Look at the right-hand side also. Sometimes your doubt will be clear. Why it is not the arithmetical difference of 4? Because another bank can go long in dollar for 30 and go short in pound and euro for 20 and 14 and arithmetically still hold a net of -4. But risk-wise, it is a risk on $34 million short. So what we are capturing is the risk. Okay, this is what Nick Leeson did in a very loose term, I'm saying. So that is why it is not the arithmetical net, but the higher of the aggregate long or aggregate short. That is why 34 million is what the bank is exposed to. And if the pound or euro were going to go up price-wise, they will have to buy it back at a higher price. So they stand to lose. First bank on the left side will stand to lose on only 7 million. Second bank will lose on 34 million. Though numerically, both of them have a net of only -4 between their long and short. This is the reason. Okay. And what is the capital charge? It is 100% risk-weighted asset on the higher of the board-approved limit or outstanding. So your board may put 300 crores as the NOOPL limit. And on March 31st, the outstanding was 380 crores. Capital adequacy has to be provided at 9% plus the 2.5% capital conservation buffer equal to 11.5. And that is on 380 crores, which is the outstanding, which is higher than the limit. Normally, it will not be higher than the limit, but accidentally, if on the last day, if the outstanding is higher, then you have to provide on the higher. So question can come. Now,
sir, excuse me, sir.
Please.
Sir, what is long and short meaning, sir?
Long, you bought gold and you have kept it with you, you are long on gold. You have possessed that asset. So you have bought dollars and kept it in your Nostro account, you are long in dollar. You have sold pound, you are short on pound. Okay, now understand only that much.
When we are purchasing, that is long, and when we are selling, it is short.
I would say yes. For easier understanding, yes.
For long duration.
Sorry?
For long duration, for short duration.
Not duration. Don't confuse with duration. Long position. That's all. You hold the asset, hold the dollar, you are long. You sell the euro, you sell the pound, you are short. That's enough.
Sir, if we sell at negative, it is short, or if we sell at positive, it can call us long.
Come again.
Losing and gaining.
If we sell at negative, we should call it short, and if we sell at positive, we should call it long.
Sell at negative and sell at positive means profit-wise?
No,
Yes,
sir.
That is what it is.
So don't bring in profit at all here. This is where everywhere the mind is, whether I score 45 marks or 90 marks, I should make profit for the bank. I mean, ignore profits. That profit I am taking care of by such risk measures. That is why I am discussing. And don't bring in profit here.
Sir, short is For example, if the price is 100 and I'm assuming it will go to 95, so I short at 100 and I'll buy at 95. So this is the short concept, no?
Correct, short concept. Just like what you do in your intraday on the NSE screen. Okay, same thing, beautiful. Same thing. Equate with your stock trading, what you do intraday. Zerodha mein aap kya karenge? Same thing, correct. Correct. Okay. So that is all about long and short. Question which way it is framed, we do not know. Now, this volatility, that is the price moving from 100 to 95 or 100 to 105, how it happens, how it can be numerically captured. Okay. Now, you are the MD at the age of 40 and your treasury head comes and reports to you every day morning, 5 minutes, you have allotted him or 3 minutes. Okay. And you will ask him, how's the position? Sir, we are long in dollars. Are kitna? Okay, $3 million. What is your permitted NOPL? He may ask the board. He will know that. You will know as MD. But you will ask, sir, our limit to 10 million hai. Okay, you have shorted, sorry, you are long for 3 million. Now, if rupee, you are long on dollar. Okay, then today, yesterday, dollar rupee, USD INR closed at 80 and today USD INR is 82. So, MD is happy or unhappy?
Happy. Happy.
Happy. So that's it. Okay, so through position, you know whether bank's balance sheet is going to be in P&L, is going to be green or red. Through position. Similarly, he's a treasurer. So you ask, SLR kaise hai? SLR, mandated SLR is 18%, sir. We are at 22%. And the duration of the portfolio is 6.5 years. Okay. Then somebody is talking, please. Somebody's phone call came now. He's talking on the phone. Somebody is talking on the phone. Please mute yourself. So what happens? Bond 6.5 years is my portfolio, and board approved limit is 8 years. Please mute. Please mute. Bilkul. Yeah, please move. So bond portfolio, 6.5 years is my duration. Treasurer says you are the MD at 40, and treasurer says board has approved 8 years as my duration. Okay, and interest rate has moved from 740, that is 10-year YTM, 740 to 730, sir. So MD is happy or unhappy?
Happy.
Happy. Interest rate has come down, bond prices will go up. Happy again. Okay. Then MD may ask, hey, why you brought it down to 6.5 years? If it was 8 years, our volatility would have been more, we would have made more profit. Correct? From one measure, he is linking it to profitability now. Like this, for currency, you can have position. For equity, you can have what is the beta. For bond, you can have what is the duration. So many things. And every time then you will have to go, you at the age of 40, you are the MD, you will have to go to the calculator, or you will have to do a mental sum and find out what is the NOPL, what is the duration, what is the modified duration, portfolio kitna hai, interest rate, how much it moved, so how much profit is likely to happen, everything to. Now, if all these, so you cannot bring in duration for an equity, you cannot bring in duration for an exchange position, currency. And similarly, you cannot bring in a NOPL for a bond position, bond portfolio. A NOPL is valid only for a currency position or at best even for an equity position, not much for a bond position. So different risk measures for different asset classes. Now, if everything can be combined in one number as VAR, value at risk, okay, that is the beauty of capturing risk in a single measure. So this volatility around the mean, standard deviation, what you learned in your 10th standard or 12th standard statistics teacher, you go back to the notes, standard deviation is what is all about dispersion around the mean, and standard deviation is the square root of the variance. So daily volatility of USD INR is 2%. What will be the monthly volatility for 25 days? How will you calculate? Question can come. This is the answer because it is square rooted. Sorry, initially the mean, there is a negative and a positive sign. All you want to combine into positive. So you will square it. So now you will do the square rooting. So daily volatility into square root of number of days, 2% into 5 days is equal to 5 number. 25 square root of 25 is 5. So 10%. So daily volatility 2%, monthly volatility is 10%. This you should remember, always multiply and divide by the square root of the tenor period to find out the required answer. So similarly, you will come to know in the value at risk problems also. What is value at risk? We are covering very shortly. At that, but don't go in, you will not be given a question to calculate VAR. But unless you know the concept, you will not be able to answer some questions based on VAR also. And VAR, or even this dispersion around the mean, we try to capture only the losses and not the profits. Our accounting policy also states all notional profits are ignored, appreciation is ignored, whereas all notional losses, depreciation is provided. It is there in your annual report. Okay, so potential losses and probability of occurrence is what we look at in building a model, and therefore this potential loss is at a certain confidence level and probability of occurrence is over a period of time. It can be overnight, it can be 10 days, it can be 10 monthly, 1 month or 1 year. So that is why two parameters for expressing value at risk. One is the confidence level with which you express that volatility, and second is the time horizon. If you are an HFT trader trading portfolio overnight, so you need or you will focus on a overnight VAR. If you are an AFS or HTM portfolio holder, you may look at a 1 month VAR or even a 1 year VAR. So this is what happens or brings in the finesse in terms of horizon and confidence level in a VAR. Upside is ignored, I have already told. And 1 day VAR into square root of time will give you T VAR, that is 30 days. So square root of 30. And 1 day, 30-day VAR divided by, so there you use the square root, it gives you this. Now, as a layman, I have not gone and studied statistics. I have not gone and studied econometrics. Nothing. I am a science graduate. So what does it mean when I say the standard deviation is 12? So the volatility moves around 100 to 100 minus 12 to 100 plus 12. So that is what is the VAR number 12 or standard deviation 12, meaning to me as a layman that the volatility range will be between 88 to 112. This is what should be clear in your mind so that you can answer the question with logic. Okay. Now, what is confidence level? What is VAR and all? We will go in detail after a tea break. 11:30, we reassemble. Thank you.
Excuse me, sir.
Tell me.
Volatility and value
Like 10
addition
minutes
interrelated.
late. Can you please revise once the first slide, AFS, HTM, that slide?
Okay. AFS, HTM. No, it's okay. It's okay. AFS, HTM, we will revise at the end of the day. Perhaps we will decide. Or I will put WhatsApp questions also so you are more clear. Relax. I'll do it. Somebody else had a question?
Value at risk and volatility are interconnected.
Are?
VAR and volatility are interconnected.
Interconnected, yes. We will analyze that shortly after your tea break. We will analyze what is the interconnection. Okay, good question.
Sir, can you explain LAF, sir, liquid adjustment percentage?
Can you explain?
LAF, sir, liquidity
LAF,
adjustment.
that is what I discussed in the morning today. Put another slide also. 2 questions I have already put yesterday and today. So you interact with me on WhatsApp. I will clarify. Feel free to interact.
Thank you.
Okay. 11:30, we reassemble.